Thanks for joining us today at this Magellan update. Today we're specifically going to focus on inflation and some of the impacts that it might have on global investing. And in fact, today we have Hamish Douglas, the Portfolio Manager for the Magellan Global Fund, as well as Gerald Stack, the Portfolio Manager for our infrastructure capabilities. First off to Hamish. Hamish, there's lots of talk around the likelihood of increasing inflation. Where do you see some of those pricing pressures coming from?
Well, in terms of inflation, really we're not that focused on what the inflation statistics are today. When you think about inflation from an investment point of view, you really have to have the capacity to look out a few years, and you have to think about the environment that the world's going to be in a few years' time, and then you have to think about the expectations of consumers and people who are employed at the time in terms of their wages about their future expectations a few years out from now. And if we look a few years out from now, some of the big pressures we see around the world that we think is going to be fueling an inflationary cycle, we really start in the emerging markets. And the emerging markets, we believe, is going to be a very, very strong secular growth story over the next 5, 10, if not 20 years. And as these mass populations continue to urbanise and go up the income curve, their wages are going to increase. Certain commodity prices, particularly energy prices and food prices, are likely to increase. And as wages and inflation builds in the emerging markets, which we're already starting to see today, we think this is going to have an effect around the world, because the world's an incredibly integrated place now. So instead of having productivity gains by shifting the world's productive capacity out of the developed economies and into the emerging markets and getting cheaper goods, we believe the goods that have now been sourced out of the emerging markets are actually going to start to go up with the wages pressure and the inflationary pressures in the emerging markets. So the number one reason we see inflation a few years out from now is we see the emerging markets continue to be a prosperous place and a higher wage place and a more inflationary place. And that's going to have consequences for the rest of the world looking a few years out. Of course, many countries in the world, because of the situation they find themselves in, are inherently following at the moment very inflationary economic policies, particularly in the United States, which probably just further fuels this global inflationary trend that we see developing over the next few years.
If the world does experience a spike in inflation, how do you think world equity markets will behave? And in particular, maybe a comment on your portfolio.
Well, inflation for equity markets, inflation is generally a negative for equity markets, particularly if it rises quite substantially. What you typically will find will be the market as a whole will trade on lower price earnings multiples than it would otherwise trade on in the absence of higher inflation. So we probably see an effect in the overall valuation of the stock market. From the perspective from the Magellan Global Fund, and I'll ask Gerald to speak on the infrastructure fund, we look for businesses with inherent pricing power that can pass on inflationary effects. They may not pass them on in the first 3 or 6 months, but over time they tend to have pricing power and actually can be beneficiaries of inflation because of the margins of their businesses. So if you think of our consumer staple business around the world, the Coca-Colas and the Nestle's and the Yum brands of the world, they inherently have huge brand equity and a lot of pricing power, and therefore probably are not going to be harmed by higher inflation as we see it. Also, some of the financials we own, provided we don't get very high inflation levels and another global recession, but if we got moderately higher inflation levels like we're envisaging, some of the banks that we own around the world with higher interest rates off the back of higher inflation will actually do quite nicely in that environment. So pricing power is the key to protection against inflation, but it's still a negative backdrop for equities as a whole.
Gerald, given Hamish's comments on the likelihood and impact of inflation, how do you see it impacting particularly on infrastructure assets?
Well, as Hamish has said, pricing power is the key here. Clearly, in a scenario of rising inflation, costs are going to increase. And the great advantage that infrastructure has is that it has a structural linkage of its revenues to inflation. And I'll give you some examples. There are 3 main sectors, key sectors in infrastructure. The first is utilities, the second is toll roads, the third is airports. With utilities, they provide an essential service. They provide water or energy to households. So absolutely essential. A natural monopoly. It doesn't make economic sense run 2 sets of water pipes into your house. So essential service, natural monopoly, not surprisingly, they're regulated. Now that regulation works so that it protects you as an investor. Many people see regulation as your enemy, we see it as your friend. It means that in times of economic downturn, you have very stable demand. And similarly, in times of inflation, you can adjust your pricing to allow for that. And how do you do that? You go back to the regulator. And it's that, as I said, that regulation that provides that underlying structural protection. So in an environment where your returns are falling away because of inflation, you go back to the regulator, you put up prices accordingly to keep your returns whole. So very strong structural protection for utilities. Secondly, toll roads. Toll roads typically have a contract with the government over an extended period of time, and the contract allows the toll road owner to increase prices in line with inflation. So once again, very strong structural linkage between inflation and revenue, allowing you to pass inflation through. Similarly to utilities, you have a very stable underlying demand base. The chart that we're showing you now looks at volume increases on the Eastern Distributor in Sydney, and what it shows you is that as tolls have increased over time, so those volumes have continued to grow. So notwithstanding the fact that prices have gone up 83% over the last 10 years, volumes have continued to increase and even similarly have grown by 83%. So very strong structural protection for your underlying revenue streams. And the third sector, airports. Airports have 2 key parts to their operation. The first is aeronautical and the second is non-aeronautical, the shopping centre, the car park component of an airport. Now that aeronautical component, the delivery of passengers to a destination, that's typically regulated. So not unlike utilities, very strong structural protection through regulation. It enables you to pass on inflation. On the retail component, well, in the shopping centre component, you have a linkage between rents and CPI, in addition to which you often have a volume kicker to it. So not only do you get inflation protection, you also get to participate in the upside as volumes increase over time. In car parking, well, clearly airports have a very strong locational advantage. If you want to go to the airport, where you want to park is at the airport. So again, an ability through that strong locational advantage to pass on pricing over time. So each of these assets, each of these key segments of infrastructure, very strong protection from inflation.
And are there particular infrastructure assets that you wouldn't want to own in case inflation does spike?
Yeah, look, the key here is actually definition of infrastructure. The definition that Magellan uses looks at 2 characteristics as being key. The first is that the service or the asset provides a service that's essential: water to a house, energy to a house, the ability to transport yourself around a city through a toll road, so an essential service. The second characteristic that we're looking for is that we don't want any external variable or external factor affecting the underlying cash flows of that asset. So for example, power generation, a power station provides an essential service, it generates power. But unfortunately, the price of that power can fluctuate with every minute. It's a perfect commodity. So there's an asset that provides an essential service, but the cash flows are by no means predictable over time. So that's an asset we don't want to be in. And fundamentally, there are 4 types of risks that we're looking to avoid. So the first is sovereign risk. China, for example, has phenomenally attractive macro themes when it comes to infrastructure, but the sovereign risk levels are a little bit high for our liking, so we avoid China. Secondly, competition. Competition's a wonderful thing for an economy, but it's not great necessarily for your investment returns. And certainly in terms of the infrastructure assets that we're looking to invest in, we want to avoid competition. So where's an example of that? Retailing of power. Once again, you can't run your life without electricity in a modern Western society, but at the retail level, it's extremely competitive. That's not a place we want to be. The third is commodity price risk. I've touched on that already with power generation, but anywhere where oil, gas, energy prices affect you, where we just don't want to be. That's something that we're not in the business of predicting. And the fourth is technology risk. Clearly there are assets out there where are at the cutting edge of technology. That can mean that over time your revenues can get eaten into through technological innovation. So again, an area we don't want to be. So we end up with a fairly conservative view of the world, but it's a view of the world where, or a universe, an investment universe, where we're extremely confident in investing in, we have a high degree of confidence that those income streams will come through, and secondly, that they'll be inflation protected over time.
Thanks, Gerald. And again, if you'd like further information on anything we've discussed today, feel free to make contact with us.